Hey everyone, welcome back to Corporate Decoder, where we dive deep into the financial world so you don't have to. Today we're unraveling Synchronoss Technology's latest quarterly report, and let me tell you, it might be a bit of a roller coaster. Make sure you're subscribed and join our Discord community in the description below if you love getting these straight up financial insights. Synchronoss is giving us the scoop on their performance for the quarter ending June 30th of 2025. They're a company that operates in the tech space, providing cloud software and services that help keep subscribers well in sync. Think of your phone backing up your photos or keeping your contacts updated across devices. Let's jump straight into the numbers. Looking at the balance sheet for June 30th, 2025, we see their total assets stand at a little over $291 million. Compared to the end of 24, that's a slight decrease. On the flip side, their total liabilities are around $241 million. Now, importantly, their total stockholders' equity is about $49 million. This is a significant jump from where they were at the end of 2024 when their equity was just shy of $30 million. This is a significant jump from where they were at the end of 2024 when their equity was just shy of $30 million. This positive movement in equity is definitely something to keep an eye on. Now let's talk about how much money they actually made. For the 3 months ended June 30th, 2025, their net revenue was about $42.5 million. This is a slight dip compared to the same time last year when they brought in about $43.5 million. So revenue is down a bit. And what about the cost to deliver their services? Their cost of revenues was about $8.9 million for the quarter. This is actually a good sign as it's down from $10.4 million in the same period last year. It seems they've managed to become more efficient in delivering their core services. Their research and development spending also saw a decrease, going from nearly $11.9 million to $10.4 million. This means they're spending less on creating new things or improving existing ones, which could be a way they're cutting costs. Similarly, selling, general and administrative expenses dropped from about $12.8 million to $11.9 million. These are the day-to-day operational costs, and a decrease here suggests a tighter rein on spending across the board. Because their costs went down more than their revenue, their income from operations actually went up. For the 3 months ended June 30th, 2025, they reported an operating income of $6.9 million, a nice increase from the $4.3 million they reported in the same period last year. However, things get a bit more complicated when we look at interest expenses. Interest expense for the quarter spiked to almost $6.6 million. A significant jump from around $3.5 million in the prior year. This is heavily influenced by the new debt they've taken on. And speaking of debt, they had a $4.4 million debt modification expense. What does that mean? Basically, when they changed the terms of their loans, they had to account for some of the costs associated with that change as an immediate expense. They also reported a $2 million loss on debt extinguishment. This happens when you pay off old debt and the costs involved in doing that, like breaking certain agreements, result in a loss on paper. Here's a really interesting one. They had a foreign exchange loss of about $12.5 million this quarter. Last year, for the same period, they had a gain of about $1.2 million. This big swing means that currency fluctuations really hurt them this quarter, likely impacting their international dealings. All these financial movements, especially the higher interest and foreign exchange losses, led to a net loss of almost $20 million for the quarter. Last year, they had a net loss of only about $500,000. So despite improving their operating income through cost cuts, the other financial items really dragged down their bottom line. Let's look at the first 6 months of the year. Net revenues were about $84.7 million, down from $86.4 million in the same period last year. The story is pretty consistent with the quarterly results. Cost of revenues came in at around $17.6 million, down from over $20 million. Again, they are managing their direct costs effectively. Research and development expenses also decreased from $20.2 million to $20.1 million, and selling, general and administrative expenses also saw a reduction from $26 million to $23.2 million. This cost control led to a much stronger operating income for the first half of the year at $15.1 million compared to $8.9 million last year. That's a really solid improvement in their core business performance. But again, the interest expense is a big story. It jumped from $7 million in the first half of last year to almost $12 million this year. That's a massive increase, showing the impact of the new substantial debt. And that foreign exchange loss, it was a huge $18.1 million loss for the first 6 months compared to a $5 million gain last year. This is a really significant factor swing in their results. All of this resulted in a net loss of about $23.4 million for the first 6 months of 2025. A much worse result than the $4 million net income they had for the same period last year. So while they're cutting costs in operations, the financial and currency landscape is presenting some serious challenges. Now, let's look at how they're doing with cash. For the first 6 months of 2020-25, they generated $2.6 million from their operating activities. This is a pretty good improvement from the $11.8 million they generated in the same period last year. This shows that their cost cutting is helping their cash generation from the actual business operations. However, their financing activities used about $4.9 million in cash for the first 6 months of 2020 using $5.1 million in the prior year. It looks like they've been busy managing their debt, taking on new loans and paying off old ones. The report mentions new term loans and significant repayments of senior notes. For instance, the 2025 term loan brought in $126.4 million, but also had $7.9 million in issuance costs. They also paid off $121.4 million of issuance costs. They also paid off $126.4 million of their 2021 senior notes. Looking out ahead, their contractual obligations are substantial. Just in the next couple of years, they have tens of millions in lease obligations, purchase obligations, and importantly, loan payments coming due. For example, their 2025 term loan alone is a massive $200 million commitment with significant principal repayments scheduled over the next few years. Now, about risks. The terms of their credit agreement are quite restricted. They limit how much debt the company can take on, how they can sell assets, and other key business decisions. A breach of these covenants could mean lenders demand all the money back sooner, which could be very damaging. They were in compliance as of June 30th, but this is a constant tightrope walk. Interestingly, there were no new trading plans set up or terminated by any of the company's directors or officers during this quarter. This often means leadership isn't making significant moves to buy or sell stock through pre-arranged plans. And a quick note on those credit agreements, they've had a major amendment in April 2025 related to their 2025 term loan, which is a big part of their current financial structure. Finally, the top executives have certified that their internal controls related to financial reporting are effective. This is a standard requirement, basically saying they're confident in the accuracy of the numbers presented. So what's the picture here for Synchronoss? On one hand, they're doing a commendable job of cutting costs in their operations, leading to improved operating income and better cash generation from their core business. That's a definite positive. However, they've also taken on significant debt, which has substantially increased their interest expenses and created a large foreign exchange loss that hit their bottom line hard. This quarter, the restrictive covenants on their new loan are also a serious point of attention. They're in a critical phase of managing this debt while trying to grow their business in a competitive market. The big question is whether they can continue to control operating costs and grow revenues sufficiently to handle the increased debt burden, especially with those currency headwinds. Alright, that's a breakdown of Synchronoss' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.